Hello and welcome to today's webinar. I'm Cherry Reynard, and with me today is David Baker, a partner at Baker Steel and manager of the Baker Steel Gold and Precious Metals Fund. We're going to be talking about the extraordinary recent run in the gold price and what it means for gold mining equities. So welcome, David, and thank you so much for joining us today. Let's start with some background to the recent rally in the gold price. What have been the main things driving the gold price higher?
Well, it's been the most fantastic market over the last year and a half when gold broke out just after that. I think late early 2024, and what's happened is that the central banks have come into the market. So the central banks were sidelined, and then what we saw is that when the US placed sanctions on Russia and restricted Russians using, or the Russian central bank using its reserves and its currency, then that changed the whole perception of the US dollar. And then a lot of the other players in the market, a lot of the other central banks, realized that then they, shouldn't rely on always being friends with the US. And we're seeing at the moment with Donald Trump, some people are in, some people are out, and they just got very nervous, so they thought that basically if they held dollars and then the US decided it didn't want them to have those dollars, it would change, would restrict them. So then they started looking for an independent asset, and that asset has been gold. So they've been acquiring gold and acquiring about a quarter of annual production. So that's been the sea change in the market. What happened also is that that initial increase in the buying was hidden because we saw interest rates starting to rise, and a lot of the Western investors started dishoarding their ETFs. So they dishoarded about 1,200 tons over a couple of years. And so we didn't start seeing this the influence of this central bank buying. And in the last year and a half, it's really, really taking off. Now we're starting to see a bit of buying by the Westerners are starting to come on. But say we lost 1,200 tons, now they've bought maybe 200 tons back. So that's where we're basically at the moment. So that's one reason that that started this gold price rise. And then with Trump and his tariffs, that basically what we saw is that the market's basically a physical market in London, and in New York, basically traders buy the physical and then short the futures. So they balance their book and they do an arbitrage. And with the tariff, they thought there was a risk that basically if they put a tariff on precious metals, then basically they're going to get caught because the gold's in London and they're going to have to deliver that in America through their short position. So then they started repatriating gold, and so they've started converting, moving gold from London to the US. And there's rumours it's up to something like 2,000 tons. So that's quite significant in a market of about 4,000 tons a year. So the market's very fluid. And then we're starting to hear rumours that gold's going to get revalued. I don't know if you've seen the headlines that gold in the US on the US balance sheet sits there at about $42 an ounce. And clearly the gold price is just under $3,000 an ounce. And the feeling is, and this is what's happened a couple of times in history, that gold has been revalued, and the Treasury then takes the difference between the 42 and the current price, and that helps their balance sheet, and then they can basically borrow a bit of money. The only question with that is that, if America revalues their gold to $3,000 an ounce, that gives them a cash injection or a change in the asset side of about $800 billion. On when they 36 billion or trillion underwater, 800 billion doesn't even pay 1 year's interest. So that gives you some idea of arguably just how cheap gold is. And it's inevitable, I think, that gold is going to get revalued. If maybe it's just the central banks carry on buying it, or maybe one day we wake up and they've revalued gold and they say this is now going to be the gold price. But I think it's inevitable because the central banks have built up so many liabilities on their balance sheets and they've got so much debt. Somehow they're going to have to devalue that debt, if that makes sense. So it's just a fascinating market. And, with Trump in the White House, people are saying, well, anything can happen. They're going to launch, one rumor is they're going to launch 50-year treasury bonds and back those with gold. And that then brings gold back into the financial sphere a bit more. So I think it's who knows what's going to happen. I can't say I know all the answers, and there's gold flying around a bit, and but I think it's definitely coming back into the financial market. And the other thing is with the BRICS realizing, as I said before, because of what happened with Russia, they're looking at some, bringing gold in to settle accounts, and so they're all buying gold as well. So it's just a fantastic market at the moment.
Yeah, because it's happened at a slightly unusual time, hasn't it? Because you wouldn't normally expect gold to rally at a time when real yields are quite high and the dollar has also been quite strong. So but that hasn't been a sort of negative force as far as you can see.
No, I think what's happening there is that 36 trillion or 38 trillion of debt. I think Ray Dalio questioned from Bridgewater this week. He said to Trump, you don't do something with this deficit in a couple of years, this is going to be a nightmare. You're going to end up in a debt spiral. So I think the new US administration realized that they've got to do something. I'm hoping gold's going to come into this, but I think that the other players are realizing, do they want to take US dollar debt? Do they want, they might not get their money back. They're going to get devalued anyway. I mean, the currency is going to get devalued. So gold, because you can't print gold, like you can print dollars and we can create more dollars. Gold supply is rising by about 2% a year. So that's the argument why gold, people are buying gold instead of bonds. And we've probably all seen the graphs where China, its growth in gold reserves relative to its holdings of US treasuries. So it's a very fluid situation. I think is the key, but people are wanting that security of gold.
Yeah. So it sounds like this rally can be sustained. There are plenty of factors in place that could keep it going, keep it rolling.
Well, I think that's a fantastic question as well, because clearly, in the background, we're seeing gold and the central banks. What's also happening is if you look at the gold price as a percentage of the S&P, so the ratio of the gold price and the S&P, you find that in 2000, gold was trading around 20% of the value of the S&P. And then it rallied, it outperformed the S&P and peaked in around 2011 at about 1.6 times the value of the S&P. So it outperformed by about 8 times. Then over the last, 10, 12 years, it's been underperforming relative to the S&P. And over the last year, it started outperforming. And now we're at about half or 50% of the S&P. And we're seeing gold outperform. So we're seeing, the theory is that you're going to see capital rotation. So capital rotation out of the stock markets into physical gold. Because when gold's starting to outperform, the people then are going to underperform if they don't hold gold. So, and if you look at the value of the stock markets and the value of gold, gold is not very big in this in this market. So it doesn't take, and most investors don't hold gold. So it doesn't take a lot. People sell a bit of their stock market and buy some gold, and we're already seeing that. Then I think that's going to drive gold even further. So that whole capital rotation is what the market's talking about at the moment.
Yeah. Yeah.
So I think there's a few reasons why gold can do good.
Yeah, absolutely. No, as I understand it, in the fund, you don't invest directly in gold, but primarily in gold equities. So I wonder if you can talk a bit about what would a normal relationship between the gold price and gold equities be?
Well, think about gold equities as a bit of a derivative on the physical gold. So when the gold price goes down, they generally tend to underperform gold. When the gold price goes up, historically, they've outperformed gold. We're in a really strange market at the moment because the gold price is going up and the gold shares and our fund, we're holding performance relative to the gold price, but we're not really showing that grayed out performance to gold. We think that's coming, and there's a couple of reasons why we think that's coming. One is that the gold companies are now just in a fantastic shape. Historically, gold companies, they haven't paid much dividends, never buy back shares. They're always there. It's a capital intensive build process, and they're always going out building new mines, and so capital rates of return on capital have been fairly poor. What's happening now is because the gold price is quite good and the margins have started expanding. So when you buy a gold share, all you're buying is that margin over the life of the ounces in the ground. And so what we're starting to see is that the margins are improving. The companies are starting to pay good dividends. A lot of them are buying back shares, like Newmont is the largest gold company in the world, and that's buying back about 2 or 3% of its issued capital this year, maybe slightly more, probably 3 or 4% of its issued capital, and it's paying a good dividend. It's paying a reasonable yield. So we're starting to see this capital management, and that whole capital management is coming very much. Investors are saying we want to see the money. We want you to be, very prudent on how you're investing. If you're getting this margin, we want to see some of that margin, and that's what we've been arguing to a lot of the companies that we're investing in over the last few years. Is that if you're going to make this money, don't just carry on digging holes in the ground. Give us some. Otherwise, what's the point of doing it? Is my argument. And so what we're starting to see is more of this capital management. And that's just a fantastic story. I mean, Fresnillo, for example, yesterday they reported, and Fresnillo this time last year had no margin, and, the market, it's never going to make any money. Yesterday it announced it was going to pay a special dividend, 6% special dividend, 6% of its market cap. So the yield is going to be 6%. And it's returning 15% of its revenues to shareholders. So the stock, in my view, is still very cheap. I think that, we potentially, and that's a typical example of what we're seeing in this sector. So capital management, the returns are a lot better, more share buybacks. And so at some point, we think that the shares are going to start outperforming gold, and that's one very good reason. As long as they can keep their margins, growing, and they are doing that over the last year, we see margins expand at a greater rate than the gold price. So at the moment, if you look back at the peak of the market in 2011. So we're earning about the same amount of cash flow as a sector, yet the index is about a third lower. So the shares have been derated by a third. So we can get a good dividend yield. We think that re-rating's coming. We've given you a few reasons why we think the gold price has got further to run. So if we can capture that as well, the returns I just think are going to be fantastic. I've just come back from a conference in Miami, and I just could not be more excited. I mean, the amount of money that's going to come into this sector. Now, what's happening in this with the shares being derated is that if you look at the main share ETF, which is the GDX, they've been basically getting redemptions, and so they've lost about I think it's about $3.5 billion, about 90 million shares. So, which is nearly probably about 20% of their issued capital has been redeemed. So what you're seeing is that the people have been redeeming this ETF, yet the shares are still been going up. So if we start at some point that the gold shares break out relative to the S&P, and that's a real, people are looking at these capital rotations. So we've discussed gold outperforming the S&P itself. If gold shares can break out relative to the S&P, then we think we'll start seeing flows into this ETF, and that potentially will squeeze the market higher. So it's a very exciting story. I mean, these shares cheap, and there's going to be plenty of buyers. You know, if the companies are buying back, and then you get this external buyer as well, that's going to be very exciting.
Is this mostly a large cap story, or are you also investing in sort of further down the capitalization scale in sort of smaller mid caps, or is that not where the interest is at the moment?
There's very little interest in the junior end of the market. Where we're focusing is that large to mid cap. So we have a fund that we have daily liquidity, and we have, you know, fairly strict rules on basically meeting those liquidity requirements. And so that we're always monitoring our liquidity. If you start going down into smaller companies, then the liquidity can become an issue. But, you know, we have a bit of a mix, and obviously if you can get the right story in the junior end, then your performance can be just spectacular. So, you know, we're looking for those. You know, what we're playing as well as gold, we're playing silver. Now, my view is the silver market is just fantastic at the moment. I mean, it just looks outstanding. You know, silver's been in a structural deficit for the last 4 or 5 years. Stockpiles have basically been eaten away, and now, you know, most of the demand for silver is industrial demand. So if the investors ever come in, then the market's going to gap higher. I mean, it's going to go a lot higher. We thought it would have happened before now. So we've been carrying about 25% of our portfolio in silver equities. Silver equities, when they move, they're going to be tremendous. So we think we've got that embedded optionality in the portfolio as well. And a similar story on the platinum group metals like platinum and palladium. We bought a couple of stocks there where we think, you know, so the gold market's massive. The silver market's quite small. It's about $30 billion. And the platinum palladium market's even smaller. So money will trickle from the gold market to the silver market to the platinum market. And that small marginal increase in flows will have a tremendous impact on this market. So we think that, you know, do we have to take a lot of specific junior company risk? We don't do that. So we run a fairly concentrated portfolio of around 30 or 40 positions. So that's how we're structured. But what a fantastic market this is going to be. So we're still in the foothills. Most people aren't invested. You know, people argue that you know, there's less than 1% of investor portfolios in this sector, including physical and gold equities. So if we just start trickling a bit because of the capital rotation, then this is going to be a great sector. And like I say, the key is the fundamentals on the companies. You know, Newmont's trading at 12 times PER ratio, you know, price earnings ratio. The general market's probably 26 times. So you can buy companies which used to trade at 30, 40 times PE for 12 times with a good dividend yield with the company buying back shares. It's like, well, but they're giving them away, you know, but that will change. And we're starting to see the green shoots of that change, if that makes sense.
So the green shoots, like as markets have been sort of very disrupted since the start of the year, and you've had that sort of technology trade depreciating, you have sort of seen evidence that this could happen.
Yeah, that's that capital rotation. So,
Yeah.
you know, we're starting to see a bit of capital rotation, and that's underpinned by the central bank buying, and basically not India, China are buying. You know, now we're seeing the Chinese insurance companies have been given the green light to buy gold. Everyone's worried about Trump and, you know, what Trump's going to do. So it's like, you know,
Yeah.
then there's the story on maybe do they revalue gold? So it's interesting. You know, I think it's so our recommendation to clients would be have some gold in your portfolio, because if it starts outperforming, as we said, between 2000 and 2011, gold outperformed the S&P by 8 times. So we've just started, you know, we haven't even doubled relative to the S&P from the lows yet. So we think that it's a bit of a hedge, it's a bit of an insurance, and the gold equities are a bit of a derivative of that. Now, we think we're being paid to hold that derivative because the companies are returning capital and they're buying back shares. So that's what makes those interesting. So we'd argue buy some physical, get some physical exposure, but have a bit of, you know, fun in a fund like ours, you know, the Baker Steel fund, because when that starts moving and the money starts flowing into that, it really, I've been in this sector many, many years. And if someone had just said gold was going to be $3,000 or just under $3,000 an ounce and there'd be no interest, I'd have said, well, I don't understand that. And I look at it, and like I say, I've just been to Miami in this conference last week, and the companies are just making money hand over fist, and that's, I think, just going to get more exciting, and a lot of that money is going to come back. So when the investors twig and when they get a bit more confidence, and they're probably, you know, they're probably a bit nervous because you know, Newmont and Barrick, you know, slightly disappointed a bit, and they're seen as the market leaders, but that'll change. You know, I think when that money comes in, it's and so I'm watching that the gold price or the gold equities relative to the S&P, and I think we're starting to see gold equities start to outperform, and then they all come in at the same time, and the shares will gap up very quickly. So it's best to be, you know, have a bit now, you know, while we're waiting for these things to happen.
Absolutely. I just wonder if we could kind of wrap up by talking a little bit about what you look for in mining companies. You know, good balance sheet, strong management, all that sort of thing.
I think it depends a lot on, you know, I like some companies which, you know, clearly you want good management. Some companies which have a good margin and paying money out. Some companies which are just starting to get that margin but haven't started paying it out yet. So, you know, you want a bit of each one. And one of the measures that we look at is the market cap to revenue. So basically, how big a company is relative to its revenue. So if you can buy a company at the moment, the sector's probably trading at around 2.5 times. I think the sector finishes around 7 times, and it probably started around 1 time. So I kind of see that type of thing. So we buy a few companies which are arguably slightly higher risk, but potentially have got that real kicker, because if you get that increase in the margin, then they can turn around well. And, so that's the, it's a portfolio. I'm not buying all the best companies. We like to buy the better companies, but I'm not buying all the ones which are, returning everything. I'm looking for the ones where they're going to start returning capital, or they've got the best asset that is going to be developed fairly soon. And then if I can buy that cheap, I'm going to get a fantastic kicker. So it's a balanced portfolio. It's not, like I said, silver and the PGMs are my kicker, but we've got some great stories in the portfolio. It's just a fascinating market. I mean, the companies we saw last week, like, oh, no one's buying them.
Yeah, yeah, absolutely. Okay, well, that sounds like a really interesting story for the rest of the year. Brilliant. Okay, we'll wrap up there, David. Thank you so much for your time today, all those insights.
Thank you very much.